Do you wonder how the wealthy actually invest? What I'm about to show you is the same exact system and strategy that we use with a $3 million client so they can have the retirement of their dreams. And what's crazy is that it's not complicated. In fact, it's incredibly simple. I want you to meet Dan and Barb. They are 65 and 63 respectively, and they've done an amazing job saving and getting themselves ready for retirement. Now, to keep the same lifestyle as what they had in their working years, ideally they wanted to create about $12,000 a month after taxes every single month deposited into their bank account. But there was a problem. They knew how to grow a portfolio and get it to this point, but they weren't sure how to create income. Because every time the market dipped when they were working, they just put more money in the market, and it worked out great because they were buying investments at lower prices, which then later rebounded. But now that they are in retirement, the thought of a 30 or 40% drop in the market while they were relying upon income made them nervous. They needed a new strategy, and they needed it fast because retirement was at their doorstep. So first, we needed to get crystal clear on their different income sources and expenses they were expecting in retirement. So here's what their balance sheet looked like. They had about $4.2 million in assets. They did have a home, which I'm showing in here. They lived in Texas. They had some bank accounts that were about $140,000 in cash. But then on their investment side, right, they had a joint brokerage account that had a cost basis of about $660,000. Dan had a Roth IRA. He also had an IRA, and then Barb had an IRA. So altogether, about $3 million worth of investments. They also had a small mortgage of about $330,000 that they were pretty close to getting paid off. So on the expense side, they had some other expenses. So they were planning to pay for private medical, obviously, because they were planning to retire before age 65, and Medicare doesn't kick in until 65. So we needed to account for some additional expenses until then. This is just their home mortgage payment. But as we can see, in order for them to spend about $12,000 a month, right, on just pure living expenses, but also pull enough to pay for private medical and their mortgage, they would need to draw about $185,000 from their accounts in the first year. And that's because Social Security won't kick in until their full retirement ages, which is in 2026 for Dan and 2028 for Barb. So again, this is the picture of their balance sheet, all the different expenses where income will be coming from. And this is the first year, but let's take a look at the next 4 years, all right? So the first 5 years of retirement. So let's go to the next year, which would be in 2025, right? So what we can see is that their portfolio withdrawals are about $180,000. In the following year, again, about $180,000. And then in the 4th year, the portfolio withdrawal is expected to drop a little bit. And again, that's because Dan's Social Security is expected to kick in. And then in year 5, again, the portfolios will drop a little bit more after we've had a full year of Dan's Social Security kicking in. Now, again, these numbers are very important, so I want you to remember them, but don't worry, I'll come back to them to remind you. So now that you understand what their balance sheet looks like and the various income sources that will be coming in, let's get into the details of how their portfolio was invested as they approach retirement. So again, just kind of looking at the high level overview of just their portfolios. Barb's IRA was invested in a 2025 target date fund through Vanguard. Dan's IRA was in an S&P 500 fund. Dan's Roth IRA was in the QQQ fund. And their trust held like a broad Vanguard Total World Index fund, but also had some bond investments like a 20-year bond fund and a high yield bond fund. The allocation was roughly 65% stocks and about 35% bonds. Now you might be thinking to yourself, I don't see anything wrong with this portfolio. They've kept things low cost because they were using index funds, and they've really let markets work in their favor. But the reality is there's a massive red flags all over this thing, and they were in danger of potentially running out of money or having to massively cut their income if markets turn south. If markets had a massive run-up, they would probably be just fine, but the risk on the downside was massive. The range of returns was really wide with a portfolio like this. And this is where the portfolio that got them where they are today was not going to be the portfolio to get them through retirement. As an example, in 2022, a portfolio like this would have been down roughly 20%, which really isn't that bad considering the history of markets. And when they were working, a 20% correction was welcomed with open arms because, again, that meant they could add more money to their investments and buy at lower prices. But they are now needing to pull money from their investments to create income, and they needed $185,000 in their first year to meet their needs. And that's about 6% of the portfolio total. For example, Dan's IRA is in an S&P 500 index fund, which is a great investment, but if you're taking 6% from the portfolio, that can be a real problem during negative years. So again, look at the early 2000s and the great financial crisis. Those are really big negative years, plus you're taking out 6% from the portfolio. That's a really big problem. Now, when they came to see us, they said they had already planned this out, and that's why they put some bonds into their brokerage account, since they plan to take income from there first. And they're correct in their thinking. The problem is that they were only halfway there. The first issue is that the types of bonds they were investing in, like a 20-year bond fund like TLT, which is what they were using in this example, has done very well, especially in the past 15 years, as interest rates have been declining. But when interest rates increased in 2022, which you'll see here, these bonds, which were supposed to be relatively safe, dropped nearly 31%. That's even worse than their S&P 500 index fund. And then their high yield bond fund, which again has done quite well over the past 15 years, was down about 11% in 2022. So if they were to experience another market like this in the future, these bonds wouldn't save them, and they'd be forced to sell these bonds at a discount price, locking in the losses for the rest of their retirement. So is the solution to delay retirement closer to their full retirement age for Social Security, or maybe cut back on the $12,000 a month for living expenses? Not necessarily, and here's why. If they invested wisely, they can increase their chances of accomplishing everything they want to and not have to worry about going back to work. So again, let's remember how much they need to pull out of their portfolio in that first year, because this is incredibly important for us to determine how we should invest their money. Again, in the first year, we're expecting about $185,000 out of the portfolio. In year 2, about $179,000. In year 3, the same. Year 4, $132,000, and then in year 5, about $122,000. In total, that's about $888,000, and really what we should be doing is looking at having that amount in bonds. But for simplicity, let's just round up to $900,000. Now, we want to have the first 5 years of income in cash and short-term high-quality bonds. And why? Well, because the examples we saw earlier, if markets drop when you're creating income, you don't want to become a forced seller of stocks, but you also don't want to create income from bonds that behave a lot like stocks and can drop double digits as well. So having 5 years in cash and good bonds can allow you to ride out most market storms. It can allow you to create the monthly income that you need while giving your riskier investments like stocks time to recover. So if they needed $900,000 in bonds and they have a $3 million portfolio, that's 30%. So is the plan to put 70% in stocks and 30% in bonds across all of their accounts? Not so fast, because we wanted to do this in a way that was tax efficient. If we were going to make portfolio adjustments to get them ready for retirement, we didn't want to create a big tax bill. So let's take a look at what we proposed to them. And I want to make sure this is clear. The investments I'm about to show you are not investment recommendations. You need to do your own research and due diligence. The examples I'm going to show you are for illustrative purposes only and should not be relied upon as a basis for investment. Now, I've used Vanguard funds because they're simple and most people know what they are. So let's start with our ideas for their trust. Again, it was invested in that Vanguard Total World Index Fund, TLT, which is the 20-year Treasury fund, and then HYG, which is a high yield bond fund. Their investment in the Vanguard Total World Fund had pretty substantial capital gains because markets have been good. So we kept that investment and we actually worked around it. However, the 20-year Treasury fund and the high yield bond fund really had no gains, because they've dropped so much, especially because they dropped a lot in 2022. So specifically, those bond funds are what we could adjust. Instead of holding, long-term bonds like the 20-year or low quality like the high yield bond, we prefer short-term bonds and that are higher quality. And that's something like the Vanguard short-term treasury fund could accomplish, or even this Vanguard short-term bond index fund could accomplish, because again, these bonds are typically shorter term, and the quality of the bonds within these funds are typically higher quality, which means your ride is a lot smoother and they don't fluctuate in value as much. This is incredibly important when you're taking income in retirement. Again, you don't want to be selling investments to create your monthly income that are wildly swinging day to day, and that can happen with long-term bonds or even high yield bonds. The other thing we wanted to do was add their first year of income into a money market fund like this Vanguard money market fund. And yes, long-term, you might be giving up some potential return, but we found our clients sleep much better at night knowing their next year of withdrawals are locked in. The stock and bond market can go crazy, but next year's withdrawals and next year's income are already taken care of. And because interest rates are elevated, they could actually earn some nice interest along the way, even in this money market fund. Now, you may be asking yourself, but shouldn't I just hold on to the investments that have gone down, like the 20-year treasury or the high yield, because they may rebound well if interest rates drop? And that's a good question, but at the end of the day, we don't know what the future holds. Lots of people never expected interest rates to rise as sharply as they did and as quickly as they did. Yet many retirees who didn't use our approach were caught off guard. So you need to put yourself in a position of strength in retirement and not have to delay your retirement just because the markets turn on you at the wrong time. Now, we still need to solve the problem of the dollar amount they had in bonds in cash. And you might remember we're rounding up to, they need about $900,000 to satisfy the first 5 years worth of withdrawals in retirement. And at this point, we really only have about $400,000 invested in bonds. And that's in the trust, because again, we were able to sell those funds because they have declined in value. And that's only about 2 years worth of income. Now, again, because that Vanguard Total World Fund has appreciated so much in the brokerage account, we didn't want to sell out of that position, but we agreed to add some bonds into their IRA. And the rationale was this: if markets were really bad and they went through the cash and bonds in their trust, they could create income from their IRAs, giving markets time to recover. So we made sure to add some bonds into their IRA, such as the Vanguard Total Bond Market Fund you'll see here. And that helps them prepare for that potential reality. So what we did is we adjusted the allocation in their IRAs to be about 70% stocks and 30% bonds. And if we did that, it would bring their total bonds and cash to about $940,000, roughly 5 to 6 years worth of withdrawals. If markets continue to do great, then they could pull income from their trust and continue to replenish their cash and bonds war chest with market growth. But if things turn south, we could tap into those bonds within their IRAs to meet their income needs. And this gave them the security to know that they could create the income they wanted, even if markets weren't favorable in the early years of retirement. And lastly, I haven't forgot about it, but the Roth IRA, we kept that at 100% stocks, since that would ideally be the last account we touch in retirement due to its tax-free withdrawals. But we didn't keep it concentrated in QQQ. In fact, we greatly diversified their stock investments, as you'll see here. So we invested not only in a total stock market index, but also developed markets. We also had a little bit of emerging markets, and we also added some small cap value into their portfolio as well. These other more diversified investments like international markets, emerging, small cap value, they've been beat by the S&P 500 and QQQ over the past 10 years. So like, what gives? Why not keep money in the best performing stocks? Like, why would we want to diversify into things that haven't done as well lately? And if you've ever wondered what has historically been the best investment strategy for income in retirement, I made a video addressing that exact question, which you can watch right here. Once again, this is Alex Okagawa, partner and financial advisor here at 1 Degree Advisors. And if you're interested in learning how we help our clients gain confidence in their retirement, visit our website at onedegreeadvisors.com.